Welcome back, and now we're going to look at calculating federal income tax withholding. Once an employer has a W-4, they use the information on it to determine the federal income tax using one of two basic methods. We have the percentage method or the wage bracket method. Both of these methods distinguish between single and married statuses and provide the benefit of allowances that are claimed on the Form W-4. The method is a choice of the employer and is typically centered around the number of employees and the payroll accounting system used. Employers are not locked into one method or another. They can utilize different methods for different groups of employees. There are other methods that can be used, but it's extremely rare that they are. The wage bracket and percentage method both take into account the standard IRS deductions for a period and are theoretically designed to withhold the amount necessitated to cover the individual's tax liability for the year. Information that you need to know is marital status, the pay frequencies, so the rate of the pay periods, gross pay for the period, and the number of allowances. Now, to get started, we will actually use my little handy dandy workbook here where I have cut in some information. So we have Mr. Herman Swain, who's a waiter at Dixie Hotel. In his first weekly pay in March, he earned $360 for the 40 hours he worked. In addition, he reports his tips for February to his employer of $700. And remember, that has to be done by the 10th of the following month if the employer does not request it more frequently. And the employer withholds the appropriate taxes for the tips from his first pay in March. They want us to calculate his net take-home pay, assuming the employer withheld federal income tax under the wage bracket method for married with two, what his Social Security taxes are, and what his state income tax would be at a rate of 2%. First, we have to recognize that this is on a weekly pay frequency, that he earned $360 for 40 hours. So let's begin to compile the information necessary. So we have a weekly pay frequency. We have to determine what's taxable and what are real dollar amounts for this pay period. So let's start with his gross pay. The $360 in wages that he will receive is not only taxable, but it's also real dollars. That's how much as an organization we need to pay him. From that, we'll withhold the applicable taxes. Add to that he had $700 in cash tips from last month. Now remember, these have to be reported by the 10th of the month, if not more, 10th of the following month, if not more frequently. So there's an additional $700 he has already received that needs to be taxed in this particular period. This gives us a full taxable wages and compensation of $1,060. We have to determine OASDI. That's at a rate of 6.2%. So that will be $65.72 that we withhold from his wages. That is 6.2% of the $1,060. We then calculate HI, which is 1.45% of the $1,060, and will withhold $15.37. He has state wages that also apply, state income tax that also applies at a rate of 2% of the $1,060, so we'll withhold $21.20 for that. Now, finally, we need to take care of the federal income tax withholding. Here they've asked us to use the wage bracket method, and I'm going to pull that bracket up. So let's look and see where he is first. He is married with two allowances. So we go to the wage bracket method, and we use their tax tables. And here are the 2017 tax tables. We look for where that $1,060 sits. So it's $1,060 right here. You can't see this very well, so let me just blow this up a little bit more. It's going to take us a little bit to find it again, but, it's okay. So here we have the 1,060. So they've made 1,060, but not up to 1,070. 2 allowances right here. We come all the way down, and it's $94. So we need to withhold $94 in relation to federal income tax. So his take-home pay, which is what we are calculating, is the $360 less all of the allowances, which is $163.71. Oops. Let's drop that over there. So as you can see, using the tax tables, it tells you the exact amount that you need to withhold. And it's for a range of amount for the wage bracket method. Now we're going to actually look at the percentage method. So here they gave us a variety of employees, their marital status, the number of withholding allowances they have, their gross wage or salary, and whether they are paid weekly, bi-weekly, quarterly, semi-monthly, or monthly. And they want us to calculate the amount of taxes to be withheld for federal income tax purposes only. So the first thing we have to do is we have to come over to the handy dandy tables, and in the tables you'll notice that if we are weekly, the one withholding allowance is worth this amount. Bi-weekly, it's $155.80, semi-monthly $168.80, so on and so forth going forward. So our first individual is weekly and has 4 allowances. So they are going to be given $77.90 as their allowances because they're weekly. So let's just put that right here. We'll just make ourselves a little cheat sheet here. This is our allowances, right? So if they're weekly, they're worth $77.90. I'm going to just real quick put it all over here. Why not? It's not like I'm wasting pen and paper or ink. I'm a great fan of the electronic office and doing as much as we can digitally. Now we don't have any daily or miscellaneous here to worry about. In fact, I might have a few of these we don't need to use at all, but I'd rather have them than not. Okay, so that's what our allowances will be in each of these situations, which will make things a little bit easier for us. So we're going to start with employee number 1 here. And employee number 1 had $15.75. That's his wages. So this is gross. Now he's got 4 allowances. So we'll just look at his allowances. So that's going to be 4 times $77.90. So that means that for the tables, we want to look at $1,263.40. When we come back over to these tables, so keep in mind we're looking for $1,263.40. The tables tell us for a weekly pay period for a married person, if they're over 525 but not over 1626, that it is $35.90 base plus 15% of the excess over 525. So I will move this out of the way so we can get back to the spreadsheet. So we have to determine what the excess is over 525. And it's 15% of that plus 35.90. So 15% of 738.4 plus 35.90 gives us $146.66 that is going to be withheld from his paycheck. Now for employee number 2. This gentleman is single, claiming 0. He is paid $1,200 biweekly. So number 2 is $1,200. His allowance is $155. Actually, he has 0. So it's actually 0. Sorry. So it's $1,200. So let's come to the biweekly single person tables and look for 1,200. Well, that's going to fall in here. So it's $35.90 plus 15% of anything over $447. So what do we have that's over $447? We have $753. 15% of that is going to be $112.95. Plus we have that $35.90 base that the clerk told us. So his withholdings are going to be $148.85. My apologies. Now we're going to go to employee number 3. Employee number 3 is also single, but he's claiming 5 allowances quarterly. So his starting pay is $12,600. His allowances is 5 times the quarterly. $600, yep. So that's going to give us an amount to start with of $7,537.50. He is single and quarterly. So let me pull back up those handy dandy percentage tax tables. And let's look for the quarterly. Looks like it's over here on the second page. And the amount that we needed to look for is the $7,537.50. So looking here, he's single. He's going to fall into this 2906 through 10,063. So it's 15% of over 2906 plus 233.10. So what do we have in excess of the 2906? That's going to be attributed 15% to give us $694.72. His base was the 233.10. So his total withheld is going to be $927.83. Now, employee number 4 is starting off with $10.90 in semi-monthly. He's got 8 allowances. So it's 8 times the semi-monthly allowance, which gives us an amount. Look at the chart. Of negative 264. That means, therefore, there will be nothing withheld. There is nothing that taxes apply to. So number 5 is married. receives $8,120 monthly and has 3 allowances. So we multiply 3 times the monthly rate. That gives us an amount of $7,107.50. And we're going to pull up the nifty-difty tax tables. And let's remember he's married, and this is monthly. So let's go back to monthly. Monthly pay period, married. We're looking for $7,107.50. So that falls right here, where it's $871.05 plus 25% of anything over $70.46. Well, let's go determine what that 25% is. Sorry about that. Let's try that again. Let's open that up a little wider for me. So the 7105 is anything over 7,046. So anything over 7,046. It's going to be at a rate of 25%. So that gives us $1,538 that we will be adding to the $871.05 for a grand total of $886.43. So as you can see, the process that we go through between the percentage method and the wage bracket method are actually significantly different from one another. We're going to talk about each of these a little bit more and just go through a couple of slides here that talk about the general steps when we're doing these. So these are really great, almost step-by-step how-tos. So let's start with the percentage method. The IRS provides that statutory percentage method tables for the weekly, biweekly, semi-monthly, yada, 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 for both the married and the single person. We utilize the 2017 tables. The 2018 tables have been released, but we won't be using them in this class. In the future, the tables are published on the IRS website and easy to access. So here we have the steps used to determine federal income tax withholding using the percentage method. First, we have to determine the amount of gross taxable wages earned. If it's cents, we round to the nearest dollar. We multiply the number of allowances claimed by one allowance for the appropriate frequency from the table. So just for a quick reminder here, that's where we took this amount here. We multiplied 4 times 79. We subtract this amount for the allowances from the gross pay to find the excess of wages over allowance claimed. That gave us this much. Then we have to determine the withholding on the excess by referring to the appropriate percentage method withholding table. So we took this and we went to the withholding table. We found out what that gap was. And it would tell us a certain percentage over a certain number. So in this case, it was 15% for everything over 525. So we determine what's over 525 and apply 15%. They also tell us what that minimum was, and that minimum was $35.90. We add the $110.76 plus the $35.90 for $146.66. Once you get to using them, they're really easy to use. It just takes a little bit to get familiar with them. Now, the wage bracket method also has IRS statutory wage bracket method tables for the different pay frequencies that there are available. Again, we're using the 2017, although the 2018 were just recently released. So these are the basic steps using the wage bracket method. We determine the amount of gross taxable wages earned rounded to the dollar. We select a withholding table that applies to the employee's marital status and their pay frequency. Then we just locate the wage bracket that the wages fall into and follow that line over to the applicable column for the number of allowances that they claimed. Now, if wages happen to be higher than the last amount listed on the appropriate wage bracket table, which can happen with high wage earners, the percentage method must be used for that employee. There are two ways that we can calculate if an employee claims over 10 allowances. Because as I bring up the wage bracket table here real quick for you, let me make it readable. So here's the table. Let's flip that view. And it's at 150%, but you notice that it stops at 10. If for some reason they happen to claim over 10 allowances, we can approach this one of two ways. We can withhold if the employee had only withheld at 10 allowances. So we withhold based off this volume here, the 10. Which, as you can see, most of the time is at 0. And let's come over here to some of the larger volumes and see if they help us out anymore. So see, this is where we start having an amount. And that is really the easiest way to do it. Or we can multiply the value of one allowance by the number of allowances exceeding 10. And add this amount to the column for 10 allowances. So what we would do is, let's say they're claiming 12. So we have here $37 for 10. We back that puppy up to 2 more, and it would be 488, I think. Yeah, 498 plus 37. We can do either one of those. Either is considered acceptable. However, it's just easier to use the 10. So now before we go into supplemental pay, we're going to go ahead and look at 2 more examples dealing with federal income tax. And we will then break into another video. So we are going to look here at my handy dandy Excel sheet. And we're going to look at 4.4. So here, Ernesto Enterprises uses the wage bracket method to determine the federal income tax withholding on its employees. They want us to find the amount to be withheld from employees' wages for each that are paid. So they're using the wage bracket method. So the first individual is married with a withholding of 1. They're weekly at $12.90. So let's bring this down real quick to 100%. So it's weekly. Remember the weekly. I remember the $12.90. But for just a second here, let me see. Married with 1. So here we've got married and weekly. $12.90, so his wages are somewhere over in this general area, so I will take this back to 150%, so it's readable. So $12.90 is right here, and he is at 1, which is the second column after there. So we would withhold married weekly 1. Why, I don't know why I said $12.90. It's $12.50. It's $134 that we're going to withhold. So through this entire exercise, we can actually just follow these wage bracket methods. The second individual is single, claiming 1 weekly for $695. So let's go to single and weekly. 695. So falls in here. And 1, so he is $77. The third individual, Carl Lopez, is single and 3 and weekly. So we're still here, single and weekly. He earned $915. So let's find his wages. It's in here. And 3, which is 87. So we continue to follow that for all of these. Let's look at Terry Kim real quick because she's monthly. And they claim married and 6. So we'll bring those tables back. It's important just to remember to switch the tables for the pay frequency and the marital status. So this is a monthly, so let's see, there's weekly, bi-weekly, semi-monthly, monthly, and she earned $5,070. So let's come in here, just double check. We're on, oh, this is monthly single, she's married. So here's monthly married. 5,070 falls into here. And she claims 6 allowances. So let's see if I can do this relatively easily. So this is 0, this is 1, this is 2, this is 3, this is 4, this is 5, and this is 6 for $269. For the most part, these wage tables are super easy to use. Like I said, the trick is making sure you're on the right frequency and the right marital status, and then you just follow it over and to the right column. So rather than walk you through every single one of these, I'm just going to go ahead and populate them out. The second one that we are going to look at right now is actually for 7 as well. So underneath for 7, for 7B, let me look at its problem real quick. Okay, so for 7, this had one I wasn't able to cut and paste in the way I would like to. So let's just drop that over here so you can read the information on it. So Jen Miller made $1,090 this week. Only Social Security, fully taxable, and federal income taxes are attached to her pay. So she doesn't have any state income tax. Miller contributes $125 each week to her company's 401k plan. Now, if you'll recall, 401ks, the contributions to them are taxable for FUTA, but they are not taxable for federal income tax. And has $40 put into her health savings account. And here it says it's non-qualified, which means that we have to tax that each week. Her employer matches this $40, and the matches are not taxable either. They want us to determine her take-home pay if she's married and claims 2 allowances using the wage bracket method. So to start with, we'll go ahead and put in her gross pay. That's $10.90. I got a little bit of flipping around and transposition there, so let's go. This is 401k contributions, and this is HSA contributions. Apparently it doesn't like HSA. Contributions. So she's having $40 taken out for HSA, but that's going to be taxable. She's having $125 taken out for 401k. That's going to be taxable at the FUTA level, but not at the FIT level. So because all of it, the full $1,090 is fully taxable for OASDI, we're going to have $67.58 removed from her check. So let me just over here really quick. And then for HI, it's 0.0145 that is also fully taxable. We need to determine how much is FIT taxable. So she starts with the $1,090. The $125 for 401k is not taxable. That is a deferred compensation plan and is exempt. However, because the $40 is not part of a qualified plan for her HSA account, that is taxable. So her FIT taxable rate is $965. We're going to use the wage bracket method. So let's pull that one up. And she's married with 2. So this is weekly, semi-monthly, let's keep going, bi-weekly, look, we found weekly. Let's find married, this is also married, so $965 and 2 is $79 that will be withheld for federal income taxes. Her take-home pay is going to be gross pay less all of her deductions, voluntary, less her tax deductions. So it is $762.61.